JSPL's losses widened to 308 crores in the fourth quarter, but that was largely due to a one-time hit. The business improved operationally with strong volume growth over 30%. Let's take a closer look at the numbers with NA Ansari. He's the Chief Executive Officer at JSPL, and Nickey Mirchandani from our research team, Johnson, to take us through that conversation. Nickey, over to you.
Thank you, Neeraj, and welcome to BloombergQuint. Sir, the first question that I have for you is congratulations, good set of numbers, fairly decent show on the operational performance. But in terms of the segmental breakup, I'd like to understand Oman business, the driver behind the good performance coming in from Oman business, and also the disappointment coming in from the power business, which has registered a 31% dip in the operational performance.
This is the first part on Oman. So Oman, if you look at the EBITDA for the quarter, that's close to about $71 million. That's the kind of EBITDA which they have been able to earn, almost 120% more than corresponding quarter last year. So this has happened primarily because of several factors. One is that we have been able to increase our production on Oman. The mill, rolling mill, has been now producing more than 100,000 tons per month, and the margins, the cost has come down substantially. Therefore, the margins are quite good on rebars. We have also improved our product mix. We are selling more of value-added rounds and less of the normal square billets, and therefore the margins have gone up. So both, the one is higher level of production, lower level of cost, and the value-added grades. These are the three things which we have been doing, and of course, all that is possible only because we are able to satisfy the needs of our customers who are on a regular basis. They are very happy to deal with us. We are working not only in Oman and UAE, but also exporting to Saudi Arabia and also partly to Europe. So all in all, Oman is doing very well. And at the same time, as I had also mentioned to you, that Angul ramp up is also happening quite well. In fact, Angul this month we should be targeting more than 200,000 tons of steel to come. And so therefore, this ramping up process is happening as per schedule. As far as JPL is concerned, of course, it's not the same story. JPL, we are struggling because the coal is not available at the kind of prices which are manageable. The PPAs are not there. The PLF for the plant is just about 42–43%. So this situation can improve only if the coal is available at the kind of viable prices. And we are also kind of in touch with the ministry. We are trying to find answers. So far, we have not got any definitive answer. We are hoping that if the commercial mining of the coal starts, and that can give us coal at reasonable price, sufficient amount of coal, that could be one way out. But right now, to answer on JPL, that's something which is we still don't have a great visibility. It's not like steel, so we are still struggling out there.
I'm going to dwell on a little bit on your power business in that case. How many more quarters of pain for general power business? And also the PLF stands at 31% as compared to the 32% kind of PLF that we saw in the previous quarter. I'd like to understand, when can we see an improvement coming in on this businesses?
Let's first, let's look at it in a broader perspective. It does happen that in a large, multi-product kind of a business like steel and power, it is quite possible that all the businesses will not be doing simultaneously very well. But the very fact that steel, which is taking the maximum burden as of now, that's doing very, very well, is able to carry out that power. And despite all this, the fact is that the EBITDA in this quarter is marginally higher compared to the last quarter, but still the business is not satisfactory. It is absolutely correct. Your point is well taken. The business is not as satisfactory as what we would like it to be. And the situation can improve only if two things happen. One is the coal is made available, number one, and number two is that the PPAs go up. We of course are also hoping that the export requirement of power will also go up as the summer fully sets in, and perhaps that should also be able to give us some benefit in the coming months and the quarter. So these are the few things where we are hoping that some improvement will come, but the maximum improvement can happen only if the coal is made available at the required price.
Mr. Ansari, we saw a 17% uptick in your sales volume for FY18 at 5.44 MT. I'd like to understand what kind of volume growth are we anticipating or projecting for FY19?
If we have shared those numbers, where as of now, if we look at the standalone numbers, the production has gone up close to about 30-odd%, and in the in a quarter on in a corresponding quarter basis, we have we have produced almost about 1.6 million tons of steel in a consolidated basis in this quarter, and so going forward, I think what is important is that obviously this number is much better than earlier, but going forward, all these numbers are going to be substantially higher. For the year 2019, we are expecting a very substantial jump in our production level. Between Oman and India, we would expect these numbers to be somewhere closer to about 9 million plus, and that's the kind of number that we are expecting to do, which will be a very substantial jump. So going forward, we are very, very hopeful that with the higher level of production, we will also be able to cut down our costs better, and our profitability should improve.
Sure, Mr. Ansari, I understand that the production volumes and sales volumes are not very different. I'd like to understand if you could give us a breakup of this 9 million ton kind of volume that we're looking in FY19.
Something about 7 million tons should be done in India, and close to a little more than 2 million tons should come from Oman. This is the way that we expect it to happen.
Could you just give us some color on the Capex plans for FY19?
As you are aware, most of our Capex is already done. That work is all done, and that's how we are able to ramp up the plant very well. Of course, there are some requirement like coke oven, the balance 2 batteries of coke oven are still required to be completed, and there is some other balance items. For example, a caster is being built and so on. So these Capex requirement for the year for this year should be somewhere in the vicinity of 400 to 500 crores max. So that's the kind of number which we are expecting that to happen, and most of these things should be completed in this financial year.
Mr. Ansari, I'm going to talk a little bit about your balance sheet situation. We've seen your net debt coming down by 3,500 crore in this financial year to a number of around 42,000 odd crore. Are we expecting further deleveraging to take place in this financial year?
It is absolutely correct. So today our debt level is close to about 42,000 crores. In this year, based on our preliminary calculation for the EBITDA generation, we expect that it will come down by 4,000 to 5,000 crores. So that's the kind of number which we have in mind. This 42,000 should come down by about 4,000 to 5,000 crores in this year, purely out of the EBITDA which we expect to generate. And over and above, if there is anything else where we can do some monetization of some of our assets, we will see that. But as of now, the target, this is the target which we are talking about.
So also I'd like to understand if the company along with its other peers have taken any kind of price hike on back of higher steel prices and the falling raw material. I'd like to understand if we are looking for better steel realization in the next quarter.
If you look at two points I would like to make. Number one is, if you look at compared to April 2017, in about a year's time, if you look at the spread between our raw material basket and the finished product, let's say HRC, that has gone up by almost about 42–43%. And as a result, if you look at our EBITDA per ton in this quarter for us, this is close to about 12,800 rupees per ton, as against 9,800 which was in the earlier quarter. So therefore, there is obviously a better margin which is there, and we are hoping that in the coming few months and quarters, this similar situation will be there by and large. So certainly we are hopeful that we should have better margin on top of much higher volume. So certainly yes.
All right, Mr. Ansari, in that case, you just mentioned that your standalone EBITDA per ton stood at around 12,800 rupees, and also your margins are expected to improve from the kind of 24%. Could you give us some color as to what ballpark figure can we expect in FY19?
As I said, I mean, the last quarter was about 12,800 rupees per ton EBITDA, and we would expect that similar kind of margin would be there for 2019. And on with the much higher volume that we are talking about, obviously the overall EBITDA should be substantially higher. I'm not expecting this 12,800 to become much higher, because that kind of a number is, I think, is a sustainable number. And that's the kind of number that we expect to happen in the year.